Hi, my name is Michael Benavides, and in this project, we're going to be covering the history of money and banking from 1939 until 2020. Now, starting off in 1939, that was the end of the Great Depression. The Great Depression lasted 10 years, and it was essentially the most severe economic downturn that we have ever experienced as a country. Shifting gears into 1941, that was the start of World War II, and World War II lasted until 1945, and it had a drastic impact in the United States with federal spending totaling more than 321 billion. So that was very imperative. In 1948, the FDIC repays the initial funding loans of 289 million to the U.S. Treasury and the Federal Reserve Board. Finally, in 1956, the Bank Holding Act was imposed, which prohibited bank holding companies headquartered in one state from acquiring a bank in another state unless that state's laws authorize that acquisition. Thank you.
Hello, my name is Nathan Osornio. I will be covering 1960 to 1979. In 1965, the Great Inflation occurred. In 1967, the devaluation of the pound by 14.3% was also apparent because of the systematic impact on the world economy. In 1975, the Vietnam War ended, and the spread was over the term of 5 presidents, including President Truman, Eisenhower, Kennedy, Johnson, and Nixon. The conflict claimed 58,000 American lives and 3 million Vietnamese lives. Throughout the war, the U.S. was funding a lot of the war efforts, and they had a really big involvement in the war. Whenever it ended, the money printed had an enormous effect on the economy. Um,
So I had the 1980s and the 1990s. In 1980, Congress passed the Depository Institutions and Monetary Control Act. This act deregulated financial institutions that accepted deposits, and it strengthened the Federal Reserve's control over monetary policy. In 1989, there's a Financial Institutions Reform, Recovery, and Enforcement Act, also known as FIRIA. This is the beginning of attempts to re-regulate the banking and savings and loans industry, and it authorized the use of taxpayer money to resolve S&L failures, S&L as in savings and loans. In 1994, there was the Regal-Neal Interstate Banking and Branching Efficiency Act. This removed restrictions on the opening of bank branches in different states that was set by the McFadden Act of 1927. And in 1999, there was the Gramm-Leach-Bliley Act, which repealed significant aspects of the Glass-Steagall Act and the Bank Holding Act of 1956, and it allowed banks to offer commercial banking, securities, and insurance services all together under the same roof.
I'll be closing us out with the years 2000 and now. And starting us off, we have the Sarbanes-Oxley Act of 2002, which was one of the biggest acts we've had in our banking history, and it's also known as the Public Company Accounting Reform and Investor Protection Act. And what it did was it banned company loans and gave job protection to whistleblowers, as well as strengthening the independence of corporate boards. And this happened due to the accounting scandals at Enron, Tyco, and WorldCom. And one of the biggest things that's happened over the course of our country's history has been the Dodd-Frank Act of 2010, which had just a list of things that it did to help us out, but it was in result of the 2007-2009 stock market crash. And what it did was it stated that banks must increase their reserves. It established the Financial Stability Oversight Council, as well as the Consumer Financial Protection Bureau, and the Office of Credit Ratings also had to sign off on those with reliable credit.